Hope everybody. Thank you guys for joining us today. This is Terry with Fairway. I got Michelle here with me. Michelle is a loan officer. Michelle used to work with me as my production partner and now is an underwriter with Fairway. She's super. She is also a former underwriter.
I'm a loan officer now. You
I
said
know.
I was an underwriter.
No, I said loan officer. Thank you.
No, you said underwriter. That's okay.
She's not my wife, so even though she does sound like it.
Very
So
well if I say.
yeah, anytime I have questions in regard to underwriting, she's the person I'm calling. So if you guys have deals that have hiccups, headaches, feel free to reach out to her. She's super. She knows what's going on. She can think of creative ways to get around things. Since I have taught her, now she's on the sales side and not on the underwriting side. So take that for what it's worth. But wanted to go over a couple things with you guys today. Now more than ever, it's important to know what's going on with the lending side. If you haven't seen, rates this week have gotten worse again, even though from May 10th, we were all expected to get better. My message to buyers, the past few weeks is we may have lived in a very good time, 13 to 14 years where rates got better. We're super low. And it may be time to start thinking about maybe this is a normal rate market now. When I first got into the business, 2007, rates were 6%, rates were 7%. That's where we are right now. You have to look at the other side of the coin. If rates are higher, look at the number of banks right now that are paying big money on CDs, on money market accounts. All of that goes hand in hand. Also, folks are going to be able to write off, more interest on their mortgages this year, because they're probably going to have the ability to itemize more than the standard deduction. So you have to look at the big picture. It can't always be rate. We can't sell to rate because we can't control that. So that's been my kind of message for months now. We're going to jump into the PowerPoint here. Let me see if I can figure out. You need to screen share with me, right?
I made you host.
I'm host. All right, so I can screen share.
Hello. What's
And
up, Chad?
Bruce just stepped in too, so
All fingerprinted.
he's fingerprinted
Don't ask.
and
Don't
legal and
ask.
ready to go now. Can you see that screen? You can't see that screen, can you?
No, I see you.
All right, I gotta figure out how to get back to that. I guess I need to minimize this. Do this from the beginning. Share screen.
Technology.
Technology.
Yes, technology. I'm terrible at it. All right, now you guys can see it, right?
Yep.
Look at there.
I see it.
All right, good deal. So going to go over a quick market update and training. Bruce is here as well. You can't see him on screen, but he'll probably pipe in from time to time, so you'll hear a few things. So housing forecast, rents will continue to rise. New rents are up double digits, renewals up on average about 8%. Increases will continue. And we're still seeing shortage in housing, obviously, inventory. Everywhere I go, everywhere I talk to people, that is the big question that keeps coming up. How's inventory? Well, we all know inventory is super low. If we could all figure out a way to increase inventory, it would be beneficial to not only to the market, but to us individually, because maybe we could sell some of those houses. Me personally, I'm working on a flip right now. I've done that since November, December. I know how to scrape popcorn ceilings now. So if you need help, call me. I won't do it for you, but I'll show you how.
Or put okay.
I could put a pay to it. I did that yesterday. So we have to be hardworking in this market. And I thought about taking a picture yesterday while I was putting a pay hardworking mortgage lender here.
There you
doing
go.
mortgages. So, but like I said, inventory is the biggest question. Rates, the environment for rates is not a positive. We expected rates to get better for May 10th. We're not. And like I said, the message at this point needs to be, we're worrying about rates. You don't buy a house because of the rate. You buy a house because of other factors. You like the house, you want to build wealth, you want to build equity. So
Here's, I put my money where my mouth is, just like Terry just mentioned. So, everybody knows rates are going to go down at some point, and a lot of people are holding off until rates go down, jump back in the market. So what's going to happen? You know, it's already tight inventory at some price points. So what's going to happen when rates go down? Everybody jumps back in. You're going to pay more for the house that you could have gotten cheaper if you bought it now. So I've got two daughters at college in Birmingham, Alabama. So I just put a contract on a house there. You know, it'll cash flow if I count what I would pay for their schooling. But I'm gonna have maintenance issues and, you know, stuff happens. It's an older house. But I'm betting, not gambling, I'm betting and counting on over 4 years that home's gonna appreciate. So that's where we get to that math at the bottom. You know, where else can you invest money and make a 80% return? So if you take, you know, a $500,000 home, you put 5% down, that's a $25,000 investment. Obviously, you'll have additional costs there, but as far as the down payment goes, if you just go with a 4% appreciation annually, that's a $20,000 profit each year, and obviously that'll grow. So that's an 80% return on your money. If it's a rental property, it's, you know, hopefully cash flowing, so you're covering your nut each month, and you know, you're paying the principal down while you do that, and the appreciation continues to grow. So yes, rates are high right now. I hope, you know, next year I can refinance to a lower rate on this property. I did something kind of unique. My child had, my oldest daughter there at school has a credit score, thankfully, that's decent. So we actually, she's buying the home. I'm just a non-occupant co-bar, and that's, we'll talk about some products later. So I'm able to put 5% down, get a decent interest rate, and, you know, maybe hand it off to her if she stays in that area, or keep it as a rental, or, you know, sell it in 4 or 5 years after they're done with school. So I'm you know, doing what I'm preaching. So is Terry. Terry bought a flip house and, you know, saw the benefit of that. I'm not doing quite as much sweat equity as Terry is, literal sweat equity. He goes out there every day, it seems like, to do something. You know, there's opportunity out there. And when rates get lower, the inventory is not, you know, the builders cannot keep up with inventory. So that's what we need to preach to people, is like, if we can find you the right house, yeah, maybe the payment's a little higher than what it would have been 2 years ago, but that was, you know, that was
An anomaly.
dreamland. Yeah, that was 3% rates are not normal.
Yeah, and then to me, it's about thinking outside the box, like Bruce mentioned. I mean, you're purchasing really an investment property, but you're doing it through your daughter,
Yeah,
who is actually going to live in the house.
right. So there's
So,
practical use.
you know, there's ways to do that where you can put less money down and get a better rate. And then long term, it may not be a quick term rental where you're making money this
Right.
year.
Yeah, I'm not,
but
it's not a
2,
flip,
3, 4
but
years from
I'm
now,
counting on
you
the,
can make that rental income.
what's that one thing? Don't bet against the champ. I mean,
That's right.
Is it how many years? 40? Was it a 40-year look back?
I believe it was 42-year look back with 7 years only being on
7
the
years
back.
were
It was
flat or
actually,
down.
it was
Yeah,
actually,
down.
it was actually from 1941. So the
It
chart
was
shows
70 years.
appreciation since 1941. There have only been 7 years since 1941 where homes did not appreciate. So everybody that's saying, you know, home prices are going to decline, they're not going to decline. Historically, they don't decline.
Yeah, there may be
You
a
know,
little dip.
That's
but
right.
It's not going to be much. And we're in a market. I mean, heck, just drove through every time I come to Kannapolis, there's something new. I had to drive to University City to get fingerprinted this morning for my license renewal for being a mortgage guy. But I hadn't been there in a while. I could not believe all the building and construction that's going on there. You know, we've got companies like Eli Lilly wanting to come here. So, you know, when we look at these appreciation numbers, they're national numbers. They're taking in high markets, low markets, stagnant markets, hot markets. We're in one of the hottest markets in the country. So
Year after the last several years, and
Yeah, and it's-
probably
and it's
will be.
only going to
next several.
continue. I mean, everybody, you know, wants to be in the Southeast.
Mhm.
That's why, you know, Terry and I met with this company yesterday that, and I don't know if you want to hit on that.
I mean, you
Had to
guys
come
will
out.
you probably have seen the emails where Easy Knock purchased Ribbon. So they're going to merge and come to market with a new product. We met with them yesterday because we're going to be their target group, their test group. to help put something together. And we shared some ideas on what we feel like would be good benefits to the market. And they're gonna go meet, come back with what they plan to do. There will probably be a ribbon component to it, probably with some appraisal protection, but also with some other programs that will be beneficial as well. So we're kind of excited about
Yeah,
that.
they're only jumping back into market. Ribbon went out of business because they took too much risk. Good concept, they took too much risk. But they merged with Easy Knock, and they're gonna come out with this product. They're gonna be able to either buy the departure residence or buy the home that people want, like Ribbon used to do. But they're coming back into the market only in Charlotte and Atlanta. I mean, so that just tells you how hot this market is. At a company like that, they're only going to go into markets where they know or can, almost guarantee there's going to be appreciation. So, and like Terry said, because of Terry, they're going to start this. We're going to be their test group, their test company. They're only going to allow Fairway to do it in the beginning. So it'll be pretty cool. They came to us to vet some ideas, find out, what the realtor market wants, so they can roll it out and be successful with it. But we're going to be the company that rolls it out. And again, that's 100% because the way Terry kind of grew that ribbon, and to you guys that trusted in that and use that product a lot. So it'll be exciting.
One other thing in regards to rates and, purchasing right now, everybody on this is forbidden to say, marry the house, date the rate.
Overused, but the concept is still true.
That's right.
Yeah, find the right house, we'll refinance down the road. Doesn't flow as well as marry the house, date the rate, but
I get tongue twisted, so we won't get into that. So let's get into some loan information here. So we're looking at, we'll go over FHA, VA, conventional, USDA, and down payment assistance. So FHA loans, everybody thinks this is a first-time homebuyer loan. The ideal client may be a first-time homebuyer. Doesn't have to be. It could be repeat buyers. It's a low down payment, and it's for credit challenged borrowers. They can buy, primary residence, single family condos if it's FHA approved, and manufactured homes. Manufactured for us now includes single wides. So I get questions a lot. You don't finance manufacturers. You don't finance double wides, do you? Yes, we probably do more double wides than just about anybody around. We've financed probably 4 single wides in the last 3 months. So there's a loan type out there for those properties now. So if you have questions about that, you can get with us.
and Michelle may be good to talk about this. I just had a customer that was selling a property, it was contingent on them buying the property that I was doing the mortgage for, and the titling issue came up. Is there anything, if they're going to a listing or have a buyer on a manufactured home, is there any way to check that the titling is correct up front?
I'll let you answer. I have ideas on it, but you can answer that.
Okay. So number one thing is there a lien on the property now? Because if there's a lien on the property now, and knowing who that lien holder is a huge key, because a lot of people don't know whether it's titled as real property or not titled as real property. Obviously, we can get the attorneys involved up front, and it's something that they prefer. We ask that question before we've got a deal under contract. But knowing who the lien holder is, sometimes if there is a lien holder, is a huge clue, because there's only certain people who are going to finance a
So
manufactured
Wells Fargo-
property before it's real property.
It's Wells Fargo mortgage or something, it's probably.
Yeah, I mean, if it's Household or Greentree, which those aren't names that we pop up very often anymore, considering we're out of business, but if there's a lien still
And
outstanding
you'll
on
probably
it.
see a lot of them with like Vanderbilt or somebody. I
Mhm.
mean, that may not be a clear indication because Vanderbilt finances those regularly. So, but finding that at least tells you that somebody has financed it before. And then I would get your attorney involved up front,
And talk through what the problem is. A lot of times it comes back and it's
That's
it's
right.
just like your car.
That's
It's
right.
Still
Right, and
the
then-
DMV.
we look all the time up front on tax records to see if it's taxed. And a lot of times it is already being taxed, but the
As
title
real
has,
estate.
as real estate, but the title has not been canceled, has not been vacated at the DMV. So, we have specific attorneys, Nip being one of them, that we will use because we want everything to be done quickly. We've had attorneys in other counties, and especially in rural counties, that have taken 3 and 4 weeks. to
We
get
had
stuff.
one that took 3 months.
Yeah, we had one that took 3 months.
3 months. And
So-
that's when we kind of said, no, we're going to change our process as to how we're going to do this, because everybody like, obviously dragging a transaction on for 3 months is not,
And
what
it's a
we
pretty
wanna
easy
do.
discussion. If you're the listing on, it's an easy discussion with, the buyer's agent. Hey, we've already done a title search on this. We know this has to be done. We're in the process of doing this now. If your client will use this attorney, it can speed everything up for us. So
Is there any way the client would know based on bills they get on the product? Do they get
Not
something from the DMV like you would your car tax, or,
yes.
so there is
There
some questions that can
so,
be asked?
Right, if you're at a listing appointment for a manufactured property, let's go ahead and ask how, go on and pull out your tax bill or have that ready for me so that when we meet, we can go through and look at it. And therefore, the only thing we can't get back is time. And so the more we address upfront, the more time it saves all of us at the end, and then the frustration and all those other things that pop in. So let's information gather and manage expectations appropriately from the beginning.
But the bill could be for just the land, right?
It could very well be.
Say,
It
well,
could,
yeah, here's my real
but then
estate bill, but
we can look at it.
Yes,
That's
if there's
that's when you're going to
building
engage your
value on
Fairway
it.
Custom loan officer and say, hey, is this land only, or is this
Yeah.
improvements as well?
yeah, a lot of times you look at the tax card and it'll show the
Mm-hmm.
improvement and it'll show a value there,
it's still.
but it's still
wasn't
taxed and it
released.
still needs to be canceled. So you just have to get into it from the beginning and just know that you may end up with steps that you don't have to, want to go through.
And it can always be done. It's just.
That's right.
It's just a matter of how
Yeah,
much time
we
it's
can-
gonna
we can-
take, and we
right.
don't want to have
Yeah, yeah,
delays.
yeah. But we still have somebody that's got a contact there.
We do.
We
Yeah,
do.
we use
Okay.
it. We actually have a couple contacts. So if you have questions, call
Yeah.
us.
Okay.
So FHA has become very attractive for probably last 5 months, maybe 4 or 5 months
Yeah.
ago. The FHA PMI dropped. It had been 0.85% annually. It dropped to 0.55% annually. And what that means is right now in the market, with all of the LLPA adjustments that everybody's heard about, conventional rates are a little bit higher. Conventional PMI or even a 700 credit score with 3% down or 5% down can be higher. So we're seeing that if you're a 720 credit score buyer who's putting 3 to 5% down, you have to look at FHA as a viable option right now. Whereas 2 years ago, sellers weren't taking FHA deals. The FHA PMI was higher. It didn't make sense to look at it as much. Now, buyers are getting a better rate. They're getting cheaper PMI. And because sellers are willing to take these deals, we have to look at it. It's a better deal for the buyer all the way around. Now, what I do with my clients, I instruct them up front, look, not all sellers are going to take an FHA loan. If it's an FHA, if you're an FHA buyer and you're looking at a house that got listed today and there's 10 showings today, you're not going to go in automatically and get an FHA offer accepted. If this house has been on the market 10, 15, 20 days or more, that's when you're more likely to be able to step in and have a seller accept that offer. So you have to know where you're at in the market with that loan. But it's a huge difference with the payment and the rates right now. So when we showed this option to buyers, this is the one they're going with, because if they're putting 20% down, you'd probably go conventional. They don't have PMI. If they're going to have PMI and it's cheaper and you get a better rate, why wouldn't you go with this program?
Mhm.
So
And the PMI difference, on a $200,000 loan, you're basically, with the new PMI on FHA, you're saving about $50 a month with the drop. So that's significant. Also, Terry may have mentioned this, but we can go a little bit higher on debt to income ratio on FHA loans than we can on conventional. And obviously the credit scores can be lower as well. So
yeah. FHA, we can go up to 57% back in debt to income ratio.
yeah,
So that's pretty big as far as, getting people qualified.
Yep.
It's 3.5% down. It can be gift money or down payment assistance allowed. Seller contributions are higher. You can do 6% of the sales price at 3.5% down. To get to 6% on a conventional loan, you have to get to 10% down on the loan.
so that allows you a little more flexibility if you're doing a buy down.
Right.
You can build in, 2 points from the seller side to buy the rate down.
Yep. We talked about the lower interest rates because, their rates on a FHA are not as credit driven as they are with conventional, with PMI being lower. It does stay on the loan for the life of the loan if you do an FHA loan. but we're in a market where we assume everybody's probably going to refinance short term. So if this is the loan to get you in the house and a year from now we can refinance you to a conventional, then that's what we look at. But I tell people, don't go into a loan expecting to stay in it for 30 years. You're not going to. Most people don't. You know, the reality is people typically do something different in 3 to 5 years. The maximum loan limit for an FHA in the Mecklenburg MSA is $420,680. So that means the loan amount has to be $426,80 or less. And we can go down to a 580 minimum credit score. Bankruptcy seasoning, any of the negatives, the derogatories with credits are less on the requirements for FHA. 2 years from discharge for bankruptcy, 3 years from a short sale, and 3 years from a foreclosure. VA loans, you want to take that one?
Sure. VA loans are great for active duty military and for people who have had an honorable discharge. So the VA has a funding fee, and the funding fee can be waived if you have 10% disability or more. 10% disability is a little tiny bit, and a lot of veterans we will find do have been service related disabled. So that makes it amazing to go up to 100% loan to value. So no down payment. VA loans for active duty are one of the easiest loans to underwrite that there are. The problem that sometimes realtor partners will see is property condition. And really, a lot of that is a myth. Unless we're getting into a roof situation where we've got 4 levels of shingles or more, or visible, like we're walking into the house and we see physically there's problems with it, that's when you're going to take a picture, get one of us on the phone and say, hey, I have concerns about this. More often than not, you're not going to see any difference with your appraisal than with a conventional or an FHA appraisal. It's really something that I feel like has gotten blown out of proportion and a lot of people get fearful about, but it's not something that we need to be fearful about. And let's be honest, these people are serving us and giving us the freedoms that we have. Let's give a service back to them. Those are going to be used for primary residences, single family residence, a condo if it's VA approved. VA approval isn't terrible on a condo. Also manufactured properties, any PUDs, not real different than any other loan. And we're not going to have monthly mortgage insurance.
Yeah, no monthly PMI. If the veteran does not, if the veteran receives the VA disability income and we can waive the funding fee, it's a no-brainer to use the VA loan with the veteran because you don't have the funding fee. There's no PMI monthly, and then they're 100% financing, which is way better than an FHA loan.
Also, the debt to income ratio is a lot more flexible not a lot more flexible on a VA loan. That's when we really, really want to look at a deal and maybe do a TBD underwrite, because there are times when we can go a lot higher on a VA loan than we would even on an FHA loan. But it's a case by case basis, and it depends upon how many people are in the household. A lot of different factors apply. That's really where partnering with us before we're making an offer is going to be super helpful.
And if you have veterans that have gone to get pre-qualified at other companies and get turned down, ask some questions, ask the question, was it credit related? Was it income related? Was it debt to income related? What were the issues? Because we have approved and closed veterans with at least a 72% back end, total debt to income ratio. There's a lot of lenders that once you're over 50, they won't even run it through their system to see if they can get an approval. But we have closed on one at 72. I closed it. And everybody's like, why would you even run it through? I just ran it through just to see what happened. I just wanted to, because if you have the residual income, VA has this kind of special deal where they look at the money that you're paying out monthly, versus the money that you have coming in monthly. And they consider taxes, other things as part of that. They call it residual income. So if you have money left over at the end of the month, after you pay all your bills, all your taxes, and that percentage of money left over is higher than a percentage that they require. So they require it based on where you live, what part of the country, and then
Number of people in the household.
number of people in the household. So, let's say, what is it, 713, I think, for 2 people. So if it's $713 for two people, if we're more than 120% over that number, it increases our chances of qualifying for the loan, even if they have lower credit, even if they have no money, even if they have higher debt to income. So a lot of people won't even look at that and run it through. But if you run it through and you're getting approval, then you have a loan there and you have a veteran that's going to get into
Yeah,
a household.
A lot of time, we don't want to put people in a position where they, can't make their mortgage payment.
Of
Because
course
that seems ridiculous, but a lot of times there's other income we can't factor
That's
in.
right.
Maybe
That's
it's-
right.
Maybe their VA doesn't allow unmarried person to be
Right.
on the loan with them, so there might be another person that's living in the house. There might be some, income that we can't count. But, we got to go by what we can count, and we can, what Terry was saying before, a lot of lenders have an overlay where they won't go above 50%, even on FHA loans. So we don't have that. If it works, it works. We can get it done. So,
Yeah.
You can also have more than one VA loan. So just because, let's say they've got a departure residence or another house somewhere in the background that has a VA loan on it, there's chance that we can still do 100% financing. We need to run some calculations and do it, but
Mhm.
it's certainly something that can be considered.
so we went over VA, FHA. Anyone have any questions? I don't know if there's anything in the chat
There's a
there.
few questions on the chat.
Okay.
I have
Awesome.
a fast question here. Manufactured homes VA, is that single wide as well, like FHA?
I think it is, isn't it? I'll
I
double check real quick.
believe they just opened that up, but I don't want to be 1,000% sure.
Right.
We
I'll
can,
double
we
check
can
and shoot you
certainly
a message.
respond to
Sure.
that though.
All right, and there are a few questions. Do you see them down there? There's 3 or 4 or something.
Chat.
So how do you get the VA funding fee waived? Basically, they have to receive VA disability income. So
If they receive any VA disability income, that means they are at least 10% disabled, in which case the funding fee would be waived.
And it'll show on their, what they
Their
call their COE or
their
certificate of eligibility.
that's right. And then there is PMI on a USDA loan. There's an upfront fee like with VA with the funding fee. USDA calls it a guarantee fee. So it's 1% of the purchase price. So that's tacked on to the loan, financed on top of it. So if you bought a $100,000 house, you'd have $1,000 fee financed. You'd have a loan amount of $101,000. But there's also monthly PMI at 0.35%. So it's the cheapest PMI you can get monthly on any loan, but there is PMI on it and it stays on for the life of the loan.
Let's see, just refinanced 3 months ago. So if they just refinanced 3 months ago into another VA loan and they want to buy another property with VA, that's going to be a loan. Like, we need to hear the story behind it. Like, why all of a sudden did you decide that you
3
no
months ago,
longer?
you said this is my primary.
Right,
Yeah.
3 months ago, you had an intent to live in that property for some time.
Yeah.
So that's when we need to talk and find out what the story is, because there's probably a story somewhere back there. If it's
Yeah.
just,
Could be a job.
like, if
change or
something happened, like if the, job change or
divorce.
something in a family situation, then if it's something that can be explained, we're all reasonable people. We can
Yeah.
look at it and make a determination. If it's just, now I was trying to get the cheapest
Yeah.
rate, then it
I
might,
knew
that's
we-
probably
yeah.
gonna be a no.
Of course,
but
if it
we
was
need
3
some
months
stories.
ago, they weren't refinancing for a better rate.
That is
Yeah,
true.
probably not.
So, but that would be a situation too, to look to see how much remaining entitlement do they have. If they have enough left to purchase the next house at 100%, as long as they didn't say, we're buying this as our, primary residence, and then we're moving 3 months later to another primary for no other reason.
Right, and where's the property? Is the new property that's gonna be their new primary at the beach?
Right.
Yeah.
Is it in the mountains? That's when we're gonna ask some more questions.
Hey, one other odd thing on VA that is probably not very well known. So you can actually use seller contributions on a VA loan to pay off debt to help the veteran qualify. So, if somebody has a $10,000 car payment, that's a $500 payment, and you can negotiate enough seller paid closing costs into the deal to pay off that car to help him qualify, then we can do that. That's the only loan you can do it on. You can't do that on any other loan product. So those contributions are limited to 4%. So the question always comes up, well, I'm getting, more than 4% in seller pays. The contribution limit on VA is only going to include what we're paying off. It doesn't include the closing costs. It doesn't include points that we're paying or anything like that. So if there's something that we're paying off, that's where that contributions limit comes into play. Bruce, you want to take the next one?
Conventional?
Yep, I think that's what we got in it.
Yep, is that what you're showing there?
Yeah, I can never get my screen. There we go.
All right, so conventional loans, that's your Fannie and Freddie loans. It says ideal client for, oh, it's, okay, got all. So yeah, first-time home buyers can do conventional loans. There's, most first-time home buyers are gonna qualify for 3% down. If they're at a certain income level, they may qualify for 3% down with the reduced PMI and better interest rates. So, a lot of people automatically go to FHA for first-time home buyers, but if they have decent credit, even with these, like Terry mentioned, the LLPA adjustments, those are, a lot of those are taken out for first-time home buyers. So, great program for first-time home buyers. And, I mentioned my daughter before. I have not been as deliberate. I don't know. I'm 57, so I've got 4 adult children. At least they're 18 plus. I've not been as deliberate about establishing their credit as I should have. We got them a credit card, but I should have been more deliberate. But thankfully, the daughter that is at school in Birmingham, I said, let me just try and pull her credit. She had one. She's been on our credit card for a couple of years, and we got her own credit card in November, and I pulled her credit in May. It was a 780. I was kind of shocked by that because that's pretty thin credit. So all that to say, if you have kids, once they turn, I think you have to be 18 to get a credit card, obviously make sure they're responsible with it. Don't just add them to your card. That helps if you're paying your card on time, that is. But get one in their own name, whether it's a secured card or, Target card, whatever. But get them established credit, make sure they're paying it back, make sure they're using it. But super important, as young as you can, get that credit established. And I'm sorry for all you Dave Ramsey fans, but you gotta show the ability. You gotta show the ability. I've had 27-year-olds come to me. They're like, "Well, my parents told me never get a credit card because they love Dave Ramsey." I'm like,
Yeah.
"Well, I can't get a mortgage." So, and the only way to build wealth is home ownership. So, you got to use it responsibly. So, sorry about that. All right, repeat buyers. Obviously, you can have 2 conventional loans at the same time. You have to qualify to carry both if you want to buy a second home. In North Carolina, you guys probably know there's no financing addendum in the contract. So if you own a home, and we know you're getting back to where you really can't make contingent offers now, and you want to buy that new home, as long as we can get that departure home under contract, we don't have to count that mortgage payment. Now, obviously, they're not going to have the equity if they don't actually close on the departure home first. But on a conventional loan, as long as it's under contract, we don't have to hit them with that payment. So, and that's where some of these programs like Ribbon will come into play, or Easy Knock will come into play to help with some of that. So we'll talk through that when it rolls out. Investors, typically you're going to go with a conventional loan, either Fannie or Freddie. Can't do investor loan on FHA or VA. Those are only for primary residence. Same with USDA. Property types allowed. This is going to be the most flexible. Primary residence, second homes, and investment properties. Second homes used to matter because the rates on second homes used to be as good as rates on primary residences. Was it spring of 21?
They're not anymore.
No, they're not. And I think, what was it, 2 years ago now? I think
Yeah. It was about 2 years ago.
yeah, so it's spring of 21. And I think it was because, number one, Fannie and Freddie want to make more money. But also they realized people were really, with Airbnb and to be able to self-manage short-term rentals, people were buying second homes. And yes, they were using them part of the year, but for the majority of the year, they were using them as rental property. So I think they realized that and basically started pricing second homes as investment properties. You still classify them differently. The only advantage, you can put 10% down on a second home, but the rates are so high and the PMI is so high that it usually isn't a benefit at all. But single family residence, obviously detached is fine. Attached condos, townhomes are fine with conventional loans. With condos, we're fortunate. We've got a woman in our office that is a condo certified expert. So she can pretty quickly research if something is already approved as a condo that we can lend on. FHA is easy. You just go to the HUD website and there's very few condos that are FHA approved, but we've worked with a ton of them, especially in the area. So let us know if your borrower's making an offer on a condo, just so we can see if there's any red flags. When you get to the coast, it's a little different because you got a lot of
In the
condo
mountains.
hotels, mountains, there's percentage of primary residents versus renters that you want in there. We got to review the budget. When condos started to be looked at a lot more closely, a lot of these budgets they didn't have the reserve requirement is usually the biggest thing. And a lot of the budgets did not have a reserve fund built into the budget. They might have had some contingency thing, but it's got to be called a reserve. It's got to be very specific how much is kept in there. So Patty in our offices has a lot of that information. So if you're looking at a condo or your buyer's looking at a condo, just let one of us know first, and we'll at least get some information on it and see if there's any red flags.
The biggest thing with condos too is that you can have the perfect borrower. You can have 780 credit score, putting
Yeah.
20% down, have a ton in reserves, and 2 or 3 weeks into it, find out that you can't finance for this person
Yeah.
because of this property. It has nothing to do with the borrower. It has everything to do with the property, because there's pieces of that we don't get until we get moving into the loan. And part of it's the questionnaire that we have to get
Yeah.
from, the association. And if it shows any piece of an assessment that is being used for structural repairs,
Yeah.
we can't finance that condominium at that point because of what happened in Miami. So
Or too much ownership,
that's
or
right.
too much, like
Too many.
one person owning
Yeah,
too
so-
high of a percentage, but Patty did this for us. Another lender couldn't get a deal done, and I'm like, hey, Patty, what can we do here? And we addressed it before we even took on the loan.
Yeah.
And that's when, again,
And
calling
some-
one of us is gonna really save you some
And
time. up
sometimes
front.
it's the early no that you want. It's like,
Yep.
yeah, great house. It's been on the market for 6 months because nobody can finance it.
If you're going to list that property, if you can get those pieces for us up front too, then we can say, yes, we can lend on this property. So you can, let your, buyer's agents coming in know Fairway has this property approved for conventional financing.
Yeah.
So that'll help you speed up the process a little bit too.
And sometimes it's just like I had a buddy of mine buying a condo that looked fine. I mean, he knew there was a lot of second homes, primary occupants. But when we got the paperwork back, there was major litigation. So anytime there's pending litigation against the HOA, that's a red flag, and we typically can't lend against it. So the earlier you find out, the better. Program highlights 3 to 5% down. Again, you got to be a first-time home buyer. For 3% down, that's generally defined in most programs as not having owned a home in the last 3 years. 5% down, anybody can do the 5% down. You're going to have just the monthly PMI, there's no upfront PMI, but you're going to have the monthly if you put less than 20% down. PMI has gotten really cheap, but it's a risk-based product. So if you have a couple things, if you have 2 borrowers, it's generally cheaper because I think the assumption is if one of them loses their job, there's a second income in the household. And then credit score is the other thing, and then down payment. But with decent credit and 2 borrowers, even with 5% down, you can get PMI very, very inexpensively. And we'll do that. You've probably seen the spreadsheets that we use. If somebody comes to me and says, I want to put 20% down, and I see they've got decent credit, I'll run them, 5 and 10. I'll send them what they want, but then I'll also add 5 and 10% and say, look, you could, you're buying a $400,000 house. You can keep $40,000 in your pocket, still put 10% down, and your PMI is only $68 a month or something. And they're like, I thought I had to put 20. It's like, yeah, you can get out of the PMI, but would you rather keep 40,000, maybe pay your car loan off, or do improvements to the house right away for $68 a month? And they usually are like, yeah, that makes a whole lot of sense. And the other thing is sometimes they're they want to put 20% down, but they hadn't sold their house, put the 10%, the 5% down. All of our loan products let you make a lump sum principal payment after closing. And you can pay, I think it's $500 now, to have the payment re-amortized. In other words, you buy a house, you put 10% down, sell your house, you've got $50,000 you want to put on the principal. You call servicing, they'll say, mail this check in separately, request that the PMI be dropped, and request that the loan payment be re-amortized. So they'll receive that $50,000, apply it to the principal. If you paid through the PMI, so you've got 20% equity, that will drop off, and then the payment will reflect the lower balance for the remainder of the term. So you can do that without having to refinance. So that's huge in this market when people are making non-contingent offers and have a home to sell with a bunch of equity that won't close till afterwards. Let's see.
Can I address that question really quick, that second part of that VA question? So Nellie, if they want to move their mom into that home and get another home for the VA, that's something where we should probably talk about it.
Yeah, no, I'll have Michelle get with you after the meeting.
Yeah, I'm happy to call you and talk through it, because it's going to be a longer conversation than just right now. But I wanted to make sure that you knew that we weren't just skipping over that.
All right, gift money is allowed really on every program except for an investment property. So that's VA, FHA, USDA, is that allowed gift? Does it?
Yeah, you
You
can.
can use it, but you can't use USDA gift funds for reserves. So,
Okay,
I mean,
gotcha.
But
you use
also
you can use
won't
for
it
closing
hit you?
costs, but not for reserve.
Won't it? It's an additional layer of risk,
Depends
though,
on,
right, on your
yeah,
AUS.
if you get enough, they have to count it as income.
Okay. But it's allowed. Just here's the deal. Don't tell, if people say, hey, my mom's going to help me out, you know, with the down payment, say that's fine, but you know, talk to your lender first so they can document it. What we don't want is mom just to give them a cash, you know, a bunch of cash that they deposit and then we can't source it. Generally the easiest thing is to have the money wired directly to closing. That way we don't have to document the, you know.
It saves a lot of
check.
steps.
Yeah, it's easier. And if something happened on the
Or already
deal,
have it.
then they didn't already give them the money and, you know, want it back. So just, again, it's fine if they tell you that, say that is awesome, that's perfectly allowed, but get with your lender so they can tell you how to document it properly. And you're, by lender, I mean someone at Fairway.
You mean one of us.
Yeah. Conservative debt to income ratio, I mean, that's, we can go up to 50% generally. And again, debt to income is all of the debt, including the new mortgage, against what the gross income is that we can qualify on that. So not to get too much in the weeds, but you guys have probably heard about these loan level price adjustments. They were actually going to hit borrowers if their debt to income ratio was over 40%. They were going to have to pay a higher rate. Thanks to some mortgage lobbying groups, that was taken out. So that's not going to happen, which is a great thing. But you know, we usually generally say 45 total debt to income ratio on conventional, but we can go up to 50. What do you say? I mean, decent credit.
A decent amount of the time. I mean,
Yeah.
it really.
It's case by case. It can be
Right, I mean,
more
there's-
down payment, or it can be.
There's
Yeah.
manual underwriting
credit.
guidelines that are in play where they may want to see it lower.
Yep.
You know, just like everything in life, it depends.
Yeah.
It depends.
But we can go up to 50. You can't go over 50, but you can go up to 50.
Correct.
Low interest rates are FICO driven. So again, this is what the loan level price adjustments are designed to, you could say penalize, they would say help the lower credit score borrowers, but you know, better credit score, better rate, just know that's absolutely true. Is it as good as it was before these adjustments came in for the better credit score borrowers? No, they're hitting them a little bit harder than they were, but still the best credit score gets the best interest rates. Seller contributions, if you put 5% or less down, it's capped at 3% of the sales price. I think, does it go to 9 once you put 10% down?
No,
10%
once you put
6.
25%.
Oh, okay. So
25.
you know, under 5% or under, it's 3% max seller contributions. 5% to 25%, it's 6% of sales price. The seller can contribute, or you know, realtor can go in there or build compensation or contributions. Over 25%, you can go to 9. That's fairly rare that you would need that much. But, you know, when you're negotiating, again, I've gotten addendums from realtors, you know, really far into the deal where they're trying to negotiate repairs and they say, hey, they're just going to give them a credit for, you know, $14,000. Well, we can't, I mean, we could find a way to use it, maybe pay points or something, but well, they're only putting 5% down, and that's, you know, that's 4% of the sales price. So we can't use all of that. So,
And
again,
don't send us the repair request.
yeah,
Please do not send us the,
Yeah.
like, as the underwriter and me just screams every single time I'm talking to a realtor, don't send us that.
Yeah,
The only thing I want to see is an addendum telling me
Yeah.
that you're paying this amount for,
yeah.
for,
We usually, we do
For
get
closing
both-
costs,
We do
I-
get both a lot.
yeah, but I don't
this
want the
is
other one.
The second
Just-
page that it does say one of one.
Just-
So it
yeah,
doesn't
just keep,
reference
just
anything
keep that.
else. But again, ask your lender, hey, what's the most the seller can pay? And again, if you guys, if you know, sometimes realtors say, well, I'll give 500 and I'll give 500. That all counts towards contributions. So, you know, let us know that as well.
Yep, let's just talk about it
Yeah.
before we finish the negotiations, because we know how difficult it is once you get that negotiation and then
Yeah.
you're like, darn it, we've already had this whole conversation. So just help us help you.
Right. Help us help you.
That's right.
Maximum loan amount is 726,200. So that is not purchase price, that's loan amount. That's unbelievable. It's that high for those of us that have been doing this for a long time. That's crazy, but that's very helpful to the market. You know, jumbo loans, anything over that loan amount is a jumbo loan, and they can have some different underwriting guidelines. The rates were a little better on jumbo than what we call conforming, but recently the conforming loan amounts have been better. Credit requirements at least a 620. We got
I've had one less than a 620, but you really wouldn't want to use a conventional loan if you're
Yeah,
below 620. It's hard to do it if you're
FHA.
really below 680.
Yeah.
So
Yeah. Did we have the FHA max loan amount in there?
580.
we did.
We did. Did I?
The loan amount's 426, yeah, or 420.
And that's, yeah, again, loan amount. So
Right.
you can have a sales price higher in FHA.
Yep.
Bankruptcy seasoning is 4 years, and that's 13N7 for
Mhm.
bankruptcy.
Mhm.
Short sale, same seasoning. It's got to be from the sale date. And sometimes people don't know that date. They think it was the date they moved out. Same with the foreclosure. It's, you know, it's the recorded date, not the date they stopped making the payment or moved out. And I think that's it on that one.
On a bankruptcy, some people don't know this. On an FHA, if you have a bankruptcy and you're actually in the bankruptcy and you've made 12 payments on it, so it has to be a 13.
Yeah.
You can
So-
actually get financing if you're in the bankruptcy.
You
I
have to
think
get
we
you have
closed
to have
one this year.
permission from-
You have to get permission
Yeah.
from the court, but honestly, it's not that
Exactly, yeah.
difficult. We've done a good number of them.
That's only on 13.
Only
only
on
on
the
13. So USDA, let's slide through this pretty quick. Not a lot of USDA opportunities in Cabarrus County. Once you get outside, you know, Rowan, Iredell, Stanley, you know, some more rural areas, there's more opportunity. First time home buyers, repeat buyers, 0 down payment. So you can actually sell your house right now and purchase your next house as a USDA loan if you don't have 20% or more in assets. If you have 20% to put down, they will not let you use a USDA loan.
Yep.
But if you don't take enough equity and you want to use USDA, typically USDA rates a little bit better. The PMI is a little bit cheaper than it would be for conventional. So it's an option worth looking at. You
They
need-
don't count retirement assets, just liquid rate.
That's right.
20%, yeah. And
Property
that's
types.
unique- That's a very unique thing that people don't know is if you've got the ability to put 20% down, you cannot do a USD loan.
That's right.
So you're
Yeah.
selling a house, like Terry said, doesn't mean you're disqualified, but if you netted a bunch of money and can put 20%, they won't let you do it.
And what we've done too is we've had somebody that was selling their house that was gonna have that, but they had car payments and stuff they wanted to pay off. So we paid those off with the proceeds at the sale.
Yeah, that's super smart.
Then we don't have the asset.
Yeah.
The asset's gone when they sold the house. So primary residence, single family residence, condo, it has to be FHA approved. I think I've done one USDA condo in my lifetime. That was it.
Yeah.
It was years and years ago. You can actually do manufactured homes. Do you have that on here, Bruce? You can do manufactured homes on a USDA loan if it's a brand new manufactured that's never been lived in. It cannot be an existing manufactured home.
They're pretty rare. Which is fine.
Program highlights, of course, geographic eligibility. So what I tell people, if you want to search, go to just Google USDA eligibility map. It'll pull up. You can put the address in and it'll tell you right away whether it's an eligible area or not. No money down, low interest rates. Again, that you have the upfront guarantee fee plus the monthly PMI, but it's cheap. There's no maximum loan amount. So it's not like conventional where they say you can't go over 726 or FHA where you can't go over 420. But what drives the loan amount is the debt to income, because USDA is very strict with their debt to income limits. It's 29% for your housing expense. It's 41% for your total expenses. And with certain criteria, if you have a credit score over 700, if you've been on your job 3 years or more, you can get waivers to go to 32% housing and 44%. It's really hard to get an approval at anything over 44. Every now and then you can get something if they have more reserves or something, but it's really limited. But that's what drives the maximum loan limit. It's typically you got income limits that you're dealing with, and you got debt to income ratios. So that loan amount is limited by how much you can make to still qualify and how much your ratios are, in order to be able to purchase that house. 620, 640 minimum credit score. The reason there's two is when you run it through their automated underwriting program, it's called GUS, Guaranteed Underwriting System. You will never, ever get an approval if you're below 640 on the credit score. The easiest way to close the USDA loan is to get a GUS approval, but you can't get that if you're under 640. So 620 to 639 is a manual underwrite for a USDA loan. So you typically have to show 29 and 41 for your ratios or less. You have to show 1, 2, 3 months reserves depending on what they're asking for. So you can get an approval 620 to 639. It just makes it a little bit harder.
We've certainly done a lot of them.
We have, yeah, we've done some. And again, bankruptcy season and GUS determines, what the time is on a bankruptcy. Short sale and foreclosure is 3 years. USDA is popular again because people are accepting FHA and VA loans. USDA is a government loan. So if you get in rural areas and it's been on the market for a little bit, I've got one right now. We paired with the $15,000 down payment assistance for a first-time home buyer. He's buying the house at $235,000. His loan amount is actually $224,000 because with the $15,000, there's no down payment. I didn't have to put any money down, but I paid all of his closing costs out of the $15,000 and still had $10,000 left over to put towards the loan amount. So he's getting a pretty sweet deal. And that'll carry us into down payment assistance. And people always get this confused with down payment assistance. They're like, it's an FHA loan, right? It's not an FHA loan. It's NCHFA that gives us the assistance. So it's not FHA. You can do any loan type with down payment assistance. So the $15K deal that's out right now, we can pair it with conventional USDA, VA, or FHA finance. And so it's a good program for everybody to look at. First-time home buyers, which, can be somebody that hadn't been on a deed for 36 months. They're actually, if you're a person who has co-signed for someone to purchase a house and you're on the deed, you're still considered a first-time home buyer if you didn't live in that house. So I have one that I closed that the lady co-signed for her son to buy a house. She's on the deed for that house because she co-signed on the loan, but she doesn't live in that house. She's never lived in that house. And we're able to get down payment assistance for her.
And the son's been making the
The
payments.
son's been making the payments. Yeah. The 640 minimum credit score, that's it. You can't do a 639. It's got to be 640 or higher. A lot of times what we'll do is we'll look at credit repair. If I got somebody at the 620, we'll do what we got to do to get the score up to get the money. Tighter DTI, they will not go over 45% debt to income on any loan. So it has to be at 45 or less. And then the income limits vary by product, family size, and location. So typically you just go to the NC Housing website, look at the county, look at the household size, and then look at, which loan are you looking to do. The regular assistance, which we rarely use right now, the income limit across the state's $126,000. In some cases, the 15K is 126, but it's probably like a 3-person household in Mecklenburg County. Rowan County is like 104, I think, maybe 102, something like that. So, but you can pull that. I have to pull it honestly for every time I look at it because I can't remember the numbers for every county that we work in. Has to be primary residence, single family, could be a condo. Interesting note on down payment assistance. There's seems to be a lot of duplexes coming on the market here and there, especially in Cabarrus County. You can use the 15K to purchase a duplex with an FHA loan and only have to put 3.5% down. So to me, that's a good program to look at for first time home buyers
I mean, you gotta
because
be living in that.
you got to live in it. You live in one side, you can rent the other side. So part of your mortgage payments being taken care of, and it's only 3.5% down. If you were to do that with a conventional loan, you have to put 15% down. So a lot of good options with down payment
Yeah,
assistance.
they drive the rate on the first mortgage, so.
Yep.
Yeah, there's no shopping around with the rates or anything. It is what it is.
So 2 days ago, the rate on the 15K from like Friday till yesterday, it was at 6.25, which was kind of odd because the rates across the rest of the market were going up. So we get back to there are people that ask every day, why should I take the down payment assistance from the state if I have my own money? Well, you can actually take the down payment assistance from the state and get a better rate. It's hard to tell people that if you bring your own money right now in today's market, if you bring your own money for the down payment, you're going to get a higher rate on your mortgage. So take the assistance, put your money away, and if you sell the house, you got it sitting there if you need it.
Okay, and the assistance is a second mortgage. It's not a grant that you don't have to repay. There is potential that you don't have to repay it, but you have to stay in the house for at least 10 years for them to start forgiving it. But it's at 0% interest. So even if you sell in 5 years or refinance, you borrow the money for free. So it's not an extra payment at all.
So on this slide, we've kind of talked about a lot of this as we've gone through the presentation today. What does no really mean? So I know in talking with a bunch of you guys, agents don't like to ask questions to borrowers about credit, income, asset type issues. But you need to know if you send them somewhere to get pre-qualified and it turns out to be a no, what was the reason for the no? Because there are a lot of factors that can be worked around. We can come up with solutions to help them turn that no into a yes. If it's a borrower that goes to somebody and they pull credit and it's a 450 credit score, that's a hard no for everybody. Now what we do, we still look at their credit report and say, hey, look, here's what's causing you the problem right now. Here's a plan for you on what you can do to get to where you need to be. And I've had borrowers that 6 months, 12 months, 18 months later come back and say, I did this, what you told me to do. Can we look now? Yeah, we got a deal. Here you go.
And just to clarify, we do not do credit repair, but we do credit advisement.
Right,
And then
right.
have to do the steps.
That's
So-
right. So
So that's a hard no. It's like, 450.
Yeah, 450 is a hard no.
515, You're.
But,
Nobody's.
if it's a borrower that had a 580, and we can get them a credit card in a month from now, have a deal. Those are things you have to look at. Amy Evans had a borrower. I think she had the listing about, I don't know, a month ago. She called me. The lender that had the deal had tried FHA and VA. They had ordered appraisals on each. It had taken them 60 days. They had not gotten anywhere close to getting the loan approved or cleared to close. She called me and asked me if I would look at it. I talked to the lady on the phone. She told me what she had. Sounded like it was a workable deal. I said, why is it taking them so? She couldn't understand it either. So we took the application. I look at it. The husband was the veteran. His credit score was lower. We ended up taking him off the loan completely, doing a conventional loan with just the wife, and closed the loan in like 12 days. So for them to sit and wait 60 days for something that was ridiculous to wait for, you have to look at different options. If you go to some lenders, and I know banks are probably really bad about this, they will look at what situation you ask them to look at and nothing outside of that box. And that box doesn't always fit what they want, but doesn't mean that it's not a good loan for somebody. So those are the chances that you need to take, get it from that person to us, because all we do is mortgages. If we don't close loans, we don't get paid, we don't stay in business, and we're pretty dang good at it. So what you have to look at is just look at the big picture. And those are the things that I want you to look at from here on out, because we all need more opportunities right now because the market is not what we want it to be. But there's deals still out there that people are being told no to, that we could get them in a house in the right situation.
We have 60 years of experience plus between the three of us sitting at this table in terms of being lenders and doing this. And
Yeah.
sometimes when you're talking to a call center loan officer or bank loan officers and even wealth management loan officers, they're not as well versed in some of the creative
And we also help
opportunities
each other.
available.
So it's
Very
like,
much so.
I might look at something for 6 hours and then you're just not even seeing the obvious thing. And I'm like, hey, Terry, Michelle, take a look at this. And they'll jump in and say, well, hey, you can move that car loan, whatever it is. So we have a bunch of eyes on it before we.
And
say
that's
no
just us.
for-
That's not even
Right.
everybody
right,
else.
right.
But-
A lot of self-employed borrowers, have their tax returns read wrong. They don't, the lenders looking at it don't understand what you can add back for additional
Or
income.
sometimes you don't want, you might have a spouse that's got a side gig and the bank or credit union, whoever said, give us all your stuff. They've got a tax return that's got a loss and that affected the income. Because they had to hit them with that loss. Most loans, we don't need to look at those tax returns.
Yeah.
If the other income is W-2 income. So it's like, sometimes it's what you leave out. Not that you're lying, but if we don't need it to underwrite the loan, we don't have to hit them with that loss.
I had a borrower recently, we closed with down payment assistance, who paid off all their credit card debt to improve their credit, to improve their situation, to be able to buy. They paid it all off. Their credit score was 632. They didn't have any money on credit cards, 632. We ran it through credit repair, and if you spend $5 on this credit card, you're going to get a 25-point increase.
Yeah.
So you're going from
Great.
632 to 657. It's like, hey, go spend money, put
Yeah.
$5 on it, and then we'll rescore you. So that was the difference between them getting no money, bringing their own down payment, and getting $15,000 from the state.
Yeah. Great.
There's a couple of questions in the chat that maybe you want to address really quick. In terms of the larger interest rate using your own money, the reason why is because the interest rate on the down payment assistance program is already set by the state versus open market.
And it's not affected by, if their credit score is a 640, they're getting the same rate than if it's an 800.
Right, there's no
So there's
difference.
no
Yeah, it's
loan
just
level
the
price
market
adjustment.
today, the market has gotten worse for rates over the last week. So if we were to price a conventional loan today with 5% down, what would we, Bruce? Probably you price one 6.5,
I'm looking at.
maybe 6.5, 675. Whereas the rate for the down payment assistance for the 15K is 6.375. 2 days ago, it was 6.25.
In terms of
Yeah.
down payment, the down payment payback, if the borrower refinances. So if the borrower refinances the loan before it's in its recapture period, so first 10 years, when we get the payoff from Service Solutions, who's the servicer of the mortgage, the second mortgage balance is in there. And it's just part of, and we pay it off with the refinance. And the number of people that we did that with over the last couple of years when rates were much lower, where they got the 8,000 or the 50, even
That's
the
right.
previous 15,000, there's many a payoff where we were paying off it in prorated portion of the DPA. And they were still walking away in a better position because
Some of them had an appreciation in 2 or 3 years where they were less than 80%.
Yeah, where there was
paying
no
that
mortgage
off.
insurance.
So, they start off at 102% and
Yeah.
again, and you guys see it too. It's these stories we got to tell these borrowers that are scared. It's like, I know, but the alternative is to pay rent or keep living with mom or dad or get into this home at this price, because it's only going to be higher next year when rates come down. Everybody's jumping back in, and you can always refinance. So don't say it, but
Yeah.
what is it? Take the rate.
I can't remember that.
we're not talking,
Sorry.
we're not supposed to say that.
Quit selling the rate. Don't sell the
And-
rate. You can't sell the rate.
For ITIN, we have an opportunity where we could broker it. Our brand, we're just not great at them, but I do have a resource where I can refer you to somebody who does ITIN.
That's awesome.
I believe that that's the last question in there.
That is it.
I just wanted to make sure that we addressed those before so that we weren't.
What can you expect? Quality service.
quick replies.
Yeah. We closed the loan.
The fastest I've ever closed on is 3 days
Can't do that.
from clear to close. Well,
Shanice and I closed one of her borrowers. We got a contract on a Friday morning. We closed the loan 10 days. We closed it the Monday of the following week.
Yeah.
So,
Yeah, I mean, unless it's gonna
Yeah,
get you
kinda
the
good.
deal or we're rescuing a deal, that's usually not, not something you guys need, but, I mean, 30 days is certainly plenty of time even on, I mean, USDA is the only loan that we lose control of it for a period of time because USDA has to review it directly, but, I think their turn times are what, 2 days?
yeah, it's been quick for a long time.
So would you say on any loan types, we need to go more than, 30 days?
Nah, 30 days. I mean, usually when people ask, my standard
3
answer is
weeks if you have
25.
to, yeah.
I say 25 days.
I said 3 weeks if you needed to get the deal. But 30 days is absolutely fine.
Rochelle is asking.
yeah,
What?
I do not speak Spanish and nobody in our branch. And there's a difference between,
Poco.
there- and there's a big difference between speaking Spanish and speaking
That even-
mortgage Spanish.
I think it's very
Because
cool.
speaking mortgage Spanish
All right.
is,
Speaking relative Spanish in general, but, I-
Yeah.
I forget my English right now and it's not.
Yep.
Yeah,
Yeah.
unfortunately, we don't, we used to, but
we don't, I mean, if you truly have somebody that absolutely needs a Spanish speaking mortgage person, got you covered,
We have a
but
couple contacts.
yeah,
And
I've
that's
got
another
your
thing to
contact.
say,
I mean,
I've done many where the teenage child came in and they were
yes,
helped us both.
absolutely.
you guys have heard me say this before.
Hmm. Yeah. Right.
Yeah.
Every loan is not a fairway loan.
No.
Okay. And there are, I know, get out of here. I'm going to say this about you. Talking Bruce. So every loan's not a
What?
fairway loan. What I ask for is I'm going to point your buyers in the right direction. I've sent people to the credit union the last 6 months,
Not if they need to get closed unless.
they have a great deal. I'm sitting here talking to Melissa. She asked me, where would you send somebody for an investment property? Well, you bank with a credit union, because today that's where I would send you. Not everybody has that option. So then I would do your deal. You wouldn't like the rate, you wouldn't like the points, but every other lender is going to offer you the same options right now if they're lenders like Fairway. So it's important that we all know the market. We all have contacts. We send people different places for different things, and it's the way that we should do business, and it's the way we do business.
Yeah, I mean,
at Fairway.
same as at the beach, if you have a condo that's, a condo
Absolutely.
hotel, or it's and like my friend that was buying down there, I said, ask the realtor, the listing agent down there, if there's a local bank that lends in there, and they were able to do it. They knew the litigation, they were comfortable with it, and they were.
That's right.
That's why you start with Fairway.
That's right.
Yep.
Exactly.
Give us the chance. Start with us, and we'll hit it right.
And we will tell you if there's somewhere better
Mhm.
to be.
We will let you
Fairway
guys
is
guide
going
them
out.
home. We will guide them to the lender.
There you go.
All right.
All right. You guys take care. Everybody have a great long weekend. It's for almost.
It's gonna be
Memorial Day,
rainy
right?
all
It's
weekend.
Memorial Day
apparently.
weekend.
Everybody's-
Yep. It's gonna be 58 and rainy on Saturday.
Sucks.
So is the race gonna be run on Monday then?
Let's run on
That's-
Monday.
It is run on Monday.
Is it?
It's run on Monday.
Oh, it's Sunday.
Yeah.
you're
No,
right.
it's
Yep.
Sunday.
Andy's.
It's all, they're all Sunday.
Trucks are Friday.
The Grand Prix of
Was-
Monaco.
run that race.
Xfinity is Saturday and then Cup is Sunday, but yes.
Hey Nelly, I'll have Michelle get with you.
Yep.
Do you have my number, Nelly?
No.
I thought that was her. That's Nelly right there. I actually, when we answered the question the first time, I thought, isn't that Nelly sitting right there? All right, guys,
See, I
take
could have
care.
turned and
Have a
talked to
great
you instead of
weekend.
talking to her.
Do you have an at a glance breakdown of a loan product?
I sure do. They're
I
right
was just
here and they're
thinking.
laminated
Yeah.
wherever. We can certainly email that to you.
Thank you, guys.
All right, take care, guys.
Couple good things. So that is